Before I unleash the power of PowerPoint to you, I want to have a few minutes to talk about what this presentation and the previous presentations that we've done under what we call the Bootcamp series. I want you to understand what I'm trying to do here, and it's not an easy task. Let me tell you what is an easy task, so you'll see why I have to make these presentations as I do. When I was an investment advisor, I had most of these tables in a drawer in my desk. And so when somebody came in, and usually they came in after they'd been to one of our workshops, but when they came in, my job was to interrogate them and learn everything I could about their financial situation. And in that conversation, I would be looking for any tips that might suggest they're overlooking some of the expenses that they might have in retirement. I would be looking for tips that might indicate that they're not really sure what their risk tolerance is, that they've faced that decision in the past. So I sit there, I listen, I make voluminous notes as I'm getting feedback. After I've had maybe a half hour, an hour with somebody, I now know when I open my desk drawer which fine-tuning table I need to look at for them, which accumulation or fixed contribution table I need to show them. And then if they're in or near retirement, for sure, I'm going to pull out one or two of the sheets that pertain to the kinds of tables I'll show you in just a few minutes. And in fact, in next week's presentation, I will show you the second half of the part on this distribution decision that we're making. But out of that conversation, I will have gotten a pretty good idea how much money they have, how much money they need, how much money they don't actually need but would like to have, and what their attitudes are around risk and all of those important aspects of the individual investor if an advisor is planning to do the work for them. But I'm not planning to do the work for you. Now, in a way, I have to show you all of the tables because the tables are all built to address some sort of a lesson. I mean, there'll be in this presentation a couple of lessons that when you see the table, you'll know what the message is. Stay away. Don't do that. But I need to show that because people will sometimes decide to take out a lot more money than they should. And because I'm just a teacher, I can't stop you except to give you the information that I have from the past. Now, let's make another thing very clear. I have been showing you and will continue to show you numbers. In some cases, I've shown you numbers going back to 1928. In most of the cases, when we talk about the fine-tuning tables and the fixed contributions and now the distribution tables, we're taking the information back to 1970. And so you have to understand that the next 54 years are in one way probably going to look like the last 54, except they won't look like that in the same sequence. In other words, there'll be some very good days. I mean, exceptional years of performance, and then there'll be mediocre, and then there will be bad performance, and then there'll be really bad performance. I have no reason to believe that the future won't look like the past, except I wouldn't even be able to. It's like trying to win a lottery to take the 30, 40, 50 years of performance and try to figure out what that might be like. Certainly not going to get it exact. But I always am concerned about the down times, about the bad times. Now, let me tell you why I'm so concerned about the bad times. I'm concerned about the bad times for a young investor because if they start investing and the market goes down for the first 5 years, even though it is the best possible thing that could happen to them because it gives them an opportunity to pick up a lot of cheap shares. That's really good, a bear market for a first time or young investor. That is not good for somebody who's going to start taking money to live on out of their portfolio. So we have to be real sensitive to defense. For the person just getting started, almost everything we talk about is offense. Defense on expenses, defense on taxes, certainly. But we want the equity portion to be thought of as being offensive. Well, we still want some growth in your portfolio once you're retired, but not the same amount that you had when you were 20. So it is my hope that by going through these numbers, we will see, one, the difference between accumulating and taking distributions. We will see the implications of taking out 3 or 4 or 5 or 6%. We will see the implications of having half of your money in bonds or 60% of your money in bonds or 0% of your money in bonds in terms of what the possibilities on the upside, but also especially on the downside might be. So with this introduction, I'm now going to load those PowerPoints up, and I'm going to go through those and hope that on every page I share with you, there will be a lesson that has meaning to you. It could be simply a yes or a no. I don't need to look at that page again. Happy I saw it, but never again. So let's get started. So, okay, welcome back. We got the numbers loaded. I hope you're ready. This, as we mentioned before, is about the distribution period of your life. You maybe spent 40, 50 years accumulating for this magic point at which you become the boss. You do not get a paycheck from the company. Well, you may be lucky and have a pension. That would be wonderful. But whatever money you need to take out of all those investments you put into a 401k and maybe a 403b or your IRAs, or maybe a taxable account. I mean, all of those are there for the taking in retirement. So let's look at a couple of these kind of introductory slides so you'll know exactly what I'm putting on the table today. We've been talking in the past segments about equity investing along with fixed income. But in the equity arena, we have boiled it down to 9 different portfolios. Now I'm talking about the equity portion. You may only have 10% of your money in equity, but it could go into the S&P 500. It could go into the 10 asset class ultimate buy and hold. It could go into the 4 fund worldwide, the 4 fund US, the 5 fund all value, the US only all value, the worldwide, and this is a real aggressive one, all small cap value, the US all small cap value, and the 2 fund US half S&P 500 and half in small cap value. Now, I'm not going to go through all of these equity portfolios applied to the distributions that you would be taken. I'm going to focus on what we'll consider to be the benchmark, the S&P 500, and I'm going to compare that, and I've been doing this in other presentations, to the 2 fund strategy, just so you can see the difference during good times and bad times. And as you see these numbers, you're going to say, wait a minute, I haven't spent nearly enough given how much money I have. Again, these tables have assumptions that you can play around with. In fact, we have a calculator uh, for playing around with it if you want to. But when we'll talk about that in depth on another presentation. But here we go. We're going to use the S&P 500 for the one equity portfolio and the two fund, half S&P 500, half small cap value. And you may remember, I don't want you to look at these numbers. I just want you to remember, if you will, that here we had a period from 1970 to 2023 with every one of these columns representing some combination of fixed income, short to intermediate term government bonds, and over here, the asset equity portfolio. In this particular case, it's the S&P 500. So these annual returns are the returns that will be the basis, depending on how much fixed income you want in your portfolio, during distribution. And for the sake of keeping it simple, I will be talking about the 60-40, and I'll be talking about the 100% equity. And I'm not expecting that many retirees are going to be 100% equity, but I want to have you get a feeling of what that portfolio does through good times and bad, even if it's only impacting 10 or 20% of your portfolio. And so here we have the S&P 500. The next one we have is the two fund strategy. Again, same period of time, same columns of combinations of fixed income and equity. Now, what I'm about to go to is a page of numbers that you may be much more comfortable with if you download the PDF and print that out. I'm going to be referencing a bunch of printed sheets here because I too cannot read this clearly, but I will take you around on the sheet where I'm looking. So here we have the first table. It's really an important table because it represents the most common equity investment that we know. That's the S&P 500. And if that were the total market index, be okay. As a matter of fact, if you had an all large cap blend international portfolio, these numbers would not be a terrible a choice of returns, because that large cap blend investment overseas is expected to have similar returns as the United States large cap blend. That's a long discussion for another day, but I'm sure that we're going to have that. Now, I want you to see what this table shows you. It assumes $1 million starting investment. Now, I know right now somebody is saying, this is worthless information. I am never going to have $1 million. So why should I be paying any attention to these numbers? Well, because that $1 million is only a relative number. Because if you have 100,000, you can divide every number by 10. If you're starting with 10 million, you can multiply every number by 10. So it's not like this isn't usable. In fact, I find having it be a round number that is so easily divisible by 10 or to multiply 10 makes it super simple for you to put it into your own terms. But $1 million today means, with a 4% distribution, and that's what I'm going to do here. I'm going to start out with a $40,000 distribution. And that is what the industry kind of says that's the amount you should be able to take out in retirement. So we're going to look at that. And I know you have a choice. You could say, I'm going to take $40,000 a year for life. Or you could say, I want to take out 40,000 because that's how much I need. Because this strategy, as it is devised here, is really based on what you need, not what you would like to have. You'd like to have twice as much money because then you'd be taking 4% out of a bigger number. But I'm hoping that this 40,000 on top of whatever else you have, Social Security or pension or whatever, will meet your cash flow needs in retirement. Now, inflation. You want to account for it? Probably. So if you look down the far right-hand side here, you will see the CPI. And that's the inflation rate each year for all of these years, 1970 through 2023. Pretty amazing for those who haven't lived through it. What must it be like to have 9, 12, 13% 3 years in a row? It was a difficult time for people. Inflation is something we should be afraid of, particularly if we're not in a position to adjust our income for that. And in reality, you can go back to 1970 and you can look at the average household income and find out that the only reason it has grown to be worth more than inflation is because today there are way more two-income families than we had in 1966 when I got into the brokerage industry, or 1970 in this table. Anyway, in fact, I'm going to tell you right now, if you got an adjustment for inflation all of these 54 years, you would have started with 40,000, and down here at the bottom, the last year's distribution would be over $300,000 to buy what $40,000 would have purchased in 1970. But keep in mind that $40,000 would have been a big number back then if the average annual income per household was $7,000. Anyway, I just want you to get a feeling of how this whole thing flows. And then we have to, theoretically, if we're going to get to know this table, realize that if $1 million is plugged in here and we have all of these different combinations of bonds, there's 100% bonds on the far left to 100% stocks or equity on the far right, you can see at the end of the first year, how did the $1 million do? And by the way, that is after you took out your distribution. Now, here's another thing about this table that could be a little misleading. My wife and I take our distributions the first of the year, and that's our money for the year. That's how we are able to kind of ignore the little ups and downs of the market and the portfolio that we're taking money out of. We just don't want to do that. In fact, if I waited till the last day of the year to take the money for that year, that number would be bigger because I would have taken $40,000 out that it could not earn any money on. So this is just one of those assumptions. I suspect that many of you don't even live with like a $40,000 distribution. You say, I'll take it when I need it. And there better be 40,000 there to cover my costs. However you go through that analysis, that's something that you're going to need to do on your own, or maybe hire an hourly advisor to help you figure out what you should be going with, using. Okay. Notice here the 60-40 strategy. Instead of ending up with under $1 million, you actually lost a few dollars because you took money out and the market didn't make enough to make up for that money you took out. But if you were 60-40, if you had part of your money in bonds to protect against a kind of a small gain for the year, no, bonds actually did better. In fact, you can see it over here. The 100% bonds ended the year with $1.1 million. But the risk takers, the 60-40s, ended with $1,044,000. The 100% ended with a little less than $1 million. Now, it's not good to look at 1 year at a time, other than to figure out what you should be looking for. I would rather have you look at 10 years at a time. I think it's more meaningful. I think it also gives you an opportunity for sometimes the market is up and sometimes it's down. Well, before we get with the S&P 500, to the bottom of that 10-year period, I want to stop right there at the end of 1974. That $1 million, after having taken out some money for 5 years, is now down to $718,000. What's the chances you're still going to be in that investment if you were retired and by chance had a spouse who was much more conservative than you? I think there'd be a few serious conversations going on because it feels like we're about to go broke. Now, in fact, it does recover. And I'm going to cheat and go all the way to the bottom down here. After 54 years, you would have had over $10 million left. But it didn't feel like you were going to end up with that. In fact, you would even say, well, I'm 60 right now. I'm not going to live for 54 years. Well, yeah, you might look at how you would have done 30 years out, over 6 million. But that's the problem with equities. The sequence of return can include some horrible periods of time that if you've got your retirement supported by a 100% equity portfolio, I just guarantee you're going to go through some moments of anxiety. Well, I can't guarantee it actually, but most do. But look at the 60-40. The 60-40, it didn't get down to 700 and something. It got down here to 900,000. Now, that may still not be something that you can stand. But if you go back and look at the returns on those fine-tuning tables, you need to understand that an all equity portfolio has got a 50% decline built into it. So what did the bonds do? Well, the bonds help to protect against the bad times in the stock market. So you didn't get down to 700,000, but you did lose 100,000. I don't know if you're still hanging on. You might be. I hope you are. I'll show you what you could do, though, to make it better in a few minutes. Hang on. But then you can drop down. You can see that by the end of 20 years, you're over 2 million at 60-40. And at the end of 30 years, you're almost to $6 million. And if you were a fire movement person who retired at age 40 and applied a 60-40 to the rest of your life, you could have actually been through this 54-year period and you would have ended up with about $8 million. And you would have taken out almost $9 million. Regardless of what column you took money out of, as long as the column made it to the bottom, you all took out exactly the same amount of money over that 54 years, $8.8 million. Oh, wait a minute. I see a couple of columns that didn't make it to the bottom. The 100% bonds and the 10% equity, 90% bonds. All the rest of them made it to the bottom. So if you've got 10, 20, 30 years left to live, and you're not trying to maximize the payout to your heirs or charities, then the S&P 500 is just fine. The only thing that I don't like about one equity asset class, large cap, basically growth, but it also has some value, so it gets the large cap blend asset class designation, is you are going to at sometimes you're going to fall during a period that not everything else falls. Now, sometimes everything can fall. 2008, everything fell. Well, I shouldn't say everything, but all the major equity asset classes did fall. On the other hand, in 2000 through 2002, as we saw earlier in the fine-tuning tables, the combinations of those other equity asset classes and the S&P 500 made it through relatively easily compared to the S&P 500. So I am rooting for you to add some additional equity asset classes so that you will help to protect against those difficult times that one asset class may have. So now you have a feeling for this table because you can kind of follow the bouncing ball wherever it leads you down a particular column. You could just put your finger on a column and you could just go down that column and look at every number. Now, the good news as an advisor, when somebody came in and I sat down with them, I had already done that. So when I had to put a finger on a column, I not only had to choose from this particular combination of equity and fixed income, but I'll take you to the next one. This is the same study, but instead of the S&P 500, it's the two fund, half S&P 500 and half small cap value. Now we also have fine-tuning table that shows a combination of other combinations of fixed income and fixed income and I'll take that back. If you want to see a table that has all equity but less than 50% small cap value, we have that. I think that table number is 14B14, if I'm not mistaken. If not, Margie's going to put it in the note field and make sure that we give access to that for those that want to see different combinations of S&P 500 and small cap value. But here we have one combination. It's the combination of 50-50. Notice in 1970, you lost more money by the end of the year. Adding small cap value did not do anything for you. As a matter of fact, instead of getting down to I think it was a low point in 74 was higher than $637,000. I mean, you lost more. And that loss of 636 is about $80,000 larger loss than with the S&P 500. So all I'm saying is adding small cap value in the long run may be better, but in the short run, it can be more damaging to your portfolio. And you can see that right here. And if you looked at the 60-40, you'll see it went down more, down to $849,000. But by the time we get out to 10 years, their returns are almost the same. But by the time we look at the whole 10 years, you will notice that the combination of S&P 500 and small cap value puts you almost $500,000 or more above the S&P 500. But on the other hand, if you had a 60-40 portfolio, you didn't have to go through the terrible time where you got down to $636,000. Instead, you got down to $549,000. So not a pretty picture if you're going through that because you don't know what's coming in the future. But that fixed income did what you hired it to do. But by the time that we get out here to the 20 years, you've got over 4 million. By the time you get out here to 30 years, the 60-40 is up to over $12 million. Now, when I look at the 60-40 with the S&P 500, at the end of 20 years, it's 2.6 million. And at the end of 30 years, it's about 5.9 million. In other words, a huge premium for having added that small cap value. And what you'll need to do as a do-it-yourself investor is go back there and familiarize yourself with how those two portfolios did during the last 54 years. In fact, the easiest way to do that is to go back to the table. I think it's H2A. We looked at the sound investing portfolio results from 1970 to 2023. I think that will give you a great look at the S&P 500 versus the S&P 500 and small cap value. And I can't help but want to share the bottom line number. If you are that fire investor, financial independence, retire early, that actually held this portfolio for 54 years, and if the future looked like the past, your original $1 million after taking out 8.9 million approximately was worth a final number of over $50 million. And the 100% equity is over 150 million. These are big decisions. You know, I've talked at length about those $12 million decisions we're talking millions. I did not talk about the difference in that book about how you could make another $1 million or more by the choice of the underlying equity portfolio you choose to build your financial future, whether it's during the accumulation period or during the distribution. Now, I'm not going to spend this long on the rest of the tables because you're going to get the feeling of decisions you could make. If you didn't like the outcome of what you just saw, taking out $40,000, and you could afford on a $30,000 or 3% of that $1 million, what happens is instead of taking out 8.8 million over the 54 years, you end up taking 6.6 million. And of course, if you took out less, that means that you would have protected the portfolio against decline during the toughest times. For example, with the S&P 500, notice with the 60/40, you get down to 958,000. And with the all equity, you get down to 760,000. So there was still pain, but not as much pain because you made this huge decision to take out less. And by the way, in a few minutes, we're going to look at taking out more. But I just want you to see what a hugely conservative decision you can make, and that is how much you take out. It's just like during the period of accumulation. You want to have less when you retire, put in less. You want to have less when you retire, put more in bonds. You want to have less when you retire, don't add small cap value. There are so many ways that you can push your portfolio forward or push it backward. There is nothing wrong with pushing it backward if it means you have greater peace of mind. So taking out the 30,000 and adjusting it for inflation, and notice that the bottom line there is much less, some 240,000 plus in the last year instead of 300,000 plus. So these are big decisions. And you will also notice, oh my gosh, I mean, you can go out 30 years here and you can see that the S&P 500 with fixed income, taking out 30,000 and adjusting for inflation, leaves you at the end of 30 years with $12 million. And you would have evidently had enough money to live on. Now, I'm saying at some point you might have turned to your spouse and said, hey, could we be taking out more and having more fun or giving it away? Certainly you could, of course. But I'm just living with the assumptions that we made for just to do this study. And with the S&P 500, it's 16. So 12 for 60/40, 16 for all equity. Well, let's take a look at the same thing using the two-fund strategy. At the end of the 20 years, 30 years, it's 16 million plus and 36 million, 34 million plus. So huge difference. Huge difference certainly for your peace of mind. And a huge difference for children and charities that you're trying to leave money to. I take that part of this decision very seriously because my wife and I are not only want to leave as much as we can to children and charities. We've made some obligations that we'd like to leave a whole lot more if we can. All that means two things: take a stance in our portfolios that suggest better rates of return, okay, in the future, and then just hope the market goes your way, okay? There's luck. There's luck. I mean, luck is a big deal. Okay. So, bottom line. Look at the bottom line. The 60/40 is worth 94 million. The 100% equity is worth 253 million. There'd be a lot of smiling faces if you lived 54 years and left that kind of money starting with $1 million. And people say, well, that could never happen. Well, if you take out this much money with this much inflation and the returns, and by the way, there were some terribly high inflationary years there that really made it hard on the portfolio. Remember, we went from starting with 30,000 to over 200,000. Okay, let's move on and let's look at the possibility. And this one has a message, loud and clear. By simply taking that distribution from 40,000 to 50,000, the S&P 500 and every other combination of fixed income, assuming you ratchet it up every year with that inflation, you ran out of money. See all that empty space there. I mean, we are right in this old area where there are no numbers. That's when you're broke and you've moved in with your kids. But also notice that if you've only got 10 years to live, then taking out $50,000 and adjusting for inflation is not likely to leave you broke. And so you could certainly look at it that way. On the other hand, if you've only got 10 years to live, people normally are really reticent to take much risk, particularly to take the risk. I mean, look at this. With the 60/40, you would have ended up with 985,000. With the 100% equity, you would have ended up with 800,000. Again, fixed income during difficult times is a great advantage to the portfolio. Not when you're young, but when you're older. Okay, that's 50,000 with the S&P 500 as the equity portfolio. All right, let's look at what happens with the two-fund strategy taking out 50,000. A bunch of the columns make it to the bottom of the page. Now, if you join me next week where we talk about flexible distributions, you are going to see these columns all make it to the bottom of the page with a relatively large amount of money left over. I think you'll find that conversation interesting. But notice, using the two-fund strategy, if you go out 20 years, you've got 3.4 million with the S&P 500 by itself, and you've got 2.9 million with the 60/40. So, as you'll see, that addition of small cap value did make a huge difference over a long period of time. And when I show you the next two slides, I want to assure you that whether you are using the S&P 500 or you're using the 60,000 plus inflation with the two-fund strategy, really nobody survived if you had to have it underwrite your cost for an extended period of time. You made it for 20 years, but that was it. And again, you may think you've only got 10 years to live, and that doesn't look all that bad, taking out 60,000 and adjusting for inflation. So I hope this information, I hope it gives you the understanding of how to use these tables. Remember, I'm counting on you to sift through the tables and to find the table that meets what you consider to be your need for return and your willingness to take risk. And you have two ways you can look at that risk. You can go back to the fine-tuning table, and you can look at the risk of the fine-tuning table with the combination of equities and fixed income, regardless which of the equity portfolios you want to use, because it will show you, and this is important, the worst year. In fact, it shows the worst 6 months, the worst year, the worst 36 months, the worst 50 months. And so, and the worst drawdown, which has no period of time attached to it, just from the peak to the valley before it turned around and made its way back up to where it started that decline. Those are all there for you to see. And then you can look at the page of distribution numbers. And you know something? If you're 20 years old or 30 years old or 40 years old, you can put together a saving rate. And you can assume that saving rate by and apply it to what happened on the contribution, the fixed contribution table. Remember, it started with 1,000. Okay, you could start with 3,000. So start with 3,000 and adjust it for 3% a year and go out 30 years or 40 years. That is, at least in theory, the kind of money that you might have available to you when you retire. And it won't be $1 million. It better not be under $1 million, or we have figured wrong. But you can take that amount of money. Let's say it's 2 million or 3 million. You then can start with 3 million. And you could look at these distribution tables and say, okay, I can multiply whatever number I'm looking at by 3. And then, to be conservative, I can reduce it by 1/3 and say, this is what I might have. I realize that's really a quick and dirty way to kind of get a sense of what a whole lifetime of accumulation and distribution can mean to you. But it's as legitimate as any to try to get a sense of what that might turn into. And again, if you be sure and join us when Chris and I and Craig Apple, who developed our calculator, lifetime investment calculator, will show you how to build the numbers for yourself using all this data that we have in these fine-tuning tables. Well, I know a lot of numbers. I hope you will download the PDF and review the numbers. And to the extent that you have questions, paul@paulmerriman.com. And in the subject line, it is helpful for me if you put fixed distributions, because on each of these major topics in Bootcamp, we are going to have a Q&A. And so, and we'll even pick up some questions that we also see in the comment section of the video on YouTube, because I want to answer the questions that maybe many have once rather than many times. And it is easier if we just create questions that apply specifically to this part of the decision-making process. So next time, we're going to be talking flexible distributions. This is the strategy my wife and I use. And I will tell you right now, remember the S&P 500 ran out of money And eventually, even with the two fund as a part of the port as the equity portfolio, it got down a lot in the end. Well, I'm going to show you a strategy that theoretically lasts forever. There's only one thing I'm going to have to ask you to have done, and that is to save more than the basic minimum. Those numbers that we looked at today assumed what you needed was a $40,000 cash flow, which would be 4% of $1 million, and that you'd be able to adjust that upwards with inflation. This next time when we talk about flexible, we're not worried about inflation anymore because you're going to be taking out way more than you need. But part of that is because you've oversaved. You'll see that in the tables. So thanks for watching. I hope you've been sticking through this whole series. I've gotten lots of feedback that it's been helpful to people. I love to get more, and hopefully we'll see you next week. Thank you.